The moment we have all been waiting for has finally arrived. Asian markets opened just a few hours ago, and the outcome is now undeniable. The banks have lost this battle. On Friday, they flooded the market with billions of dollars in paper contracts in a last-ditch effort to crush silver below the critical $65 level. Their goal was to shatter momentum before the new week began. They failed. As trading opened in Tokyo and Sydney this morning, silver did not collapse. Instead, it opened with strength, gapping higher and holding firmly above $67. This is more than a simple price move. It is a declaration of war. It confirms that Friday's sell-off was the final shot fired by the bullion banks. They are now out of firepower. The market has exposed their bluff. This is no longer a discussion about a possible squeeze. We are watching the first moves of a powerful financial event that could permanently break the dominance of the paper pricing system. To understand why this Monday open is so devastating for JP Morgan and the swap dealers, you need to examine their margin exposure. These institutions are carrying enormous short positions, betting aggressively on falling prices. Every cent that silver rises above their entry levels costs them tens of millions of dollars in additional collateral by opening above $67. The market has pushed them into maximum pain territory. They are now deeply underwater. Under normal circumstances, they would sell even more to force prices down. But that option is gone. The liquidity simply is not there. If they attempt to sell more, they risk being completely overwhelmed by buyers. If they try to buy back their positions to limit losses, they could send prices straight to $75 in moments. They are frozen, trapped in a burning building with no escape routes. The stability visible on the chart right now is not calm. It is the silence before the margin calls begin. While banks are consumed by mounting paper losses, the real economy is confronting a physical supply crisis. Elon Musk and the procurement teams at Tesla are watching this market open with alarm. Tesla does not deal in paper contracts. It relies on physical silver. A standard electric vehicle requires up to 50 grams of silver. The new Cybertruck consumes even more, with prices holding near record levels and inventories sitting at historic lows. Major technology companies are realizing that the just-in-time supply model no longer works. Reports are emerging of private, off-market deals being negotiated directly between miners and tech firms. These transactions bypass the paper exchanges entirely. This hidden demand is pulling metal out of the market before it ever reaches the vaults. When Elon Musk realizes that silver for solar panels is no longer readily available, he will not simply buy the metal, he may choose to acquire the mines themselves. This growing industrial panic is the force that could drive prices from $70 to $100, and the engine behind this squeeze is operating thousands of miles away from Wall Street. The Shanghai Gold Exchange opened with explosive momentum. Silver premiums in China have expanded once again. This indicates that silver now commands a far higher value in Shanghai than it does in New York or London. That price gap creates an unstoppable pull. Every available bar of silver in the West is being rushed onto ships and aircraft, redirected toward eastern markets. This arbitrage is rapidly emptying the vaults of the London Bullion Market Association at a pace never witnessed before. The West continues to suppress prices in a desperate attempt to defend the dollar, while the East exploits that suppression to siphon off the West's strategic resources. This is the largest transfer of wealth in history, unfolding openly for anyone paying attention. For 2 decades, high-frequency trading algorithms have dictated silver prices. These systems are programmed to sell aggressively when prices reach predefined resistance levels. But today, something has changed. The algorithms are executing sell orders. Yet prices refuse to fall. This is a textbook case of algorithmic failure. When artificial intelligence recognizes that selling no longer works, it is designed to reverse course. It flips from net short to net long when that switch occurs, potentially later today or tomorrow. The market will experience an automated buying frenzy. The same machines that suppress prices for years will become the force that launches them higher. We are now witnessing machines turning against their creators. On screens, silver may appear to trade near $67, but attempt to buy it. Call a dealer or visit an online retailer and the reality becomes clear. Actual prices are far higher, premiums are surging, delivery delays are growing. This widening gap is a classic signal of a collapsing currency system. The paper exchange insists that silver supplies are abundant. The physical market tells a very different story. This contradiction cannot persist. Eventually, the paper market must fail. When it does, prices will not climb slowly, they will reset overnight. We are approaching a point where exchanges may declare force majeure and settle contracts in cash because the metal simply does not exist. If you hold a paper contract on Monday morning, you do not own silver, you own a legal claim. From a technical standpoint, conditions are aligning for a gamma squeeze later this week. The options market is heavily stacked with call positions at the $70 and $75 levels as prices approach those thresholds. The banks that sold these options are obligated to hedge by purchasing futures. This forced buying acts like gravity, pulling prices upward. It creates a self-reinforcing cycle. As prices rise, buying accelerates. As buying accelerates, prices climb further. Friday's close lit the spark. Monday's open supplied the fuel. $70 is the ignition point. Once crossed, the explosion becomes mathematical and unavoidable. The psychology of the market has undergone a fundamental transformation. For years, silver investors were worn down by repeated setbacks. They sold at the first hint of a rally. But look at sentiment today. No one is rushing for the exits. What once began as a fringe online idea has now grown into a global investment narrative. The fear of missing out is starting to take hold. Retail investors who watched Bitcoin soar are now searching for the next major opportunity. They see silver breaking higher, they see banks cornered, and when the retail crowd arrives, as they are doing now, the silver market simply does not have the liquidity to absorb them. It's like forcing the flow of Niagara Falls through a garden hose. The pressure has only one possible outcome. We need to be clear about what this implies for the banking system. If silver reaches $100, several major financial institutions become technically insolvent. Their short-sighted liabilities would exceed their Tier 1 capital. This is why they are resisting so fiercely. This is also why the media remains silent. They are fighting for survival. If control over silver slips away from the shock spreads to gold, then into the bond market, and eventually into the US dollar itself. Silver is the critical link, the small cog that turns the entire machine. By holding above $67 this morning, the market is effectively placing immense pressure on the banking cartel. This is about far more than money. It is about power. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively reducing their dependence on the dollar. They are constructing a new trade settlement system backed by tangible commodities. Silver plays a central role in that framework. By accumulating physical silver, they are insulating their economies against the potential collapse of fiat currency. Monday's strong opening confirms that the East is supporting prices. They are establishing a firm floor under the market. They will not allow a collapse because they control the physical supply. The West is short, the East is long, and in any resource conflict, the side that owns the resources ultimately prevails. The shortage is now moving further down the supply chain. It began at the mines, then it reached the refiners. Now it is impacting the mints. The US mint is already operating under allocation. Private mints are overwhelmed with back orders. Next, the strain will reach manufacturers. When companies like Samsung can no longer secure silver paste for electronics, panic will follow. They will bid prices to whatever level is required. Industrial demand does not respond to price. This means manufacturers must buy silver regardless of cost. They cannot produce smartphones without it. This price and elastic demand is the ultimate backstop for silver investors. Prices must rise high enough to force people to sell personal holdings just to keep factories running. That price is not $67. It is likely well above $200. Pay attention to what is missing from today's headlines. CNBC is focused on technology stocks. Bloomberg is discussing interest rates. Yet no one is talking about silver reaching a new all-time high. That silence is intentional. They do not want the public to notice. They want to keep attention elsewhere while insiders quietly position themselves. But charts do not lie. Volume does not lie. Media silence is the strongest confirmation that this move is real. They ignore only what they fear. And right now, nothing scares them more than a full-scale run on silver. Traders must be prepared for the exchange to intervene unfairly if prices gap toward $80 this week. Do not be shocked if trading is suddenly halted. They will cite extreme volatility. They will adjust margin requirements. They will attempt to force liquidations. We have seen this playbook before, with nickel and with the Hunt brothers, but this time is not the same. The physical market is simply too strong. If the paper exchanges shut down, real trading will not stop. It will move to Shanghai. It will migrate to private peer-to-peer networks. Closing the casino does not end the game. It only proves that the house is insolvent. So what comes next? If silver holds above $67 through Monday's session, there is virtually no resistance ahead. There is no historical ceiling above this level. We have entered true price discovery. From here, the upside is open. Technical analysts anticipate a rapid push towards $75, followed by a brief consolidation, and then an explosive move toward $100. At $100, mass hysteria begins. That is when your taxi driver starts talking about silver. That is when your grandmother asks how to buy coins. We are not there yet. We are still in the smart money phase. The public mania stage has yet to arrive, and that is where the largest gains are made. Monday is here. The disaster everyone predicted never occurred. Prices held firm. The thesis is validated. The squeeze is underway. If you are waiting on the sidelines for a pullback, you may be waiting indefinitely. The train has already left the station, and the doors are closing. The transfer of wealth is happening right now, in real time. On the screen in front of you, the banks wagered against reality, and reality is winning. Do not let them manipulate your perception. Do not let them shake you out of your position. Hold steady, watch the gap, and prepare for the ride of a lifetime.